Hello, how are you? Hi, what are rates doing right now? I'm going to address that here in a second. Thanks for joining me today. Also got a couple tips for you, a couple of myths I'm going to try to bust today in the mortgage industry. Josh Thomas here in the state of Utah, mortgage broker, helping Utah families, empowering them with the financial knowledge to pay their homes off in half the time. Anyway, I'm going to go ahead and address interest rates first, and then I'll go ahead and talk about a couple other things as I mentioned. So, without further ado, let's go ahead and get that going. I'm going to share my screen here in a second. If I can find that button. But hope you're having a good day so far. Of course, if you're joining me, thank you for taking the time out of your day to spend some time with me. I do wish these were interactive. And so if you have a second and you want to drop a little comment or a message or something, even if it's like, hey, your videos are really boring, that's okay. But it'd be nice to hear from any of you guys. So feel free to drop a comment in there or share what it is you liked most or any constructive feedback you might have. But interest rates, you're looking at them. This is as of Monday, March 20th, excuse me, April 20th. Um, but interest rates have been mostly sideways for the last week. If you saw rates last week, they're pretty similar to what they are right now. Basically, you've got, what was it, March 1st or the end of February, we had the best rates we'd had in 4 years, just barely, but we hit the national average of a 5.9, which is a great rate. Higher than what you're seeing here because both these are reflecting buy down points. But the 5.9, there wouldn't have been any points on that, but that was the national average rate. Anyway, Iran started and the Strait of Hormuz being a problem started. And in short order, there was big inflation concerns as home or gas prices went up, and everybody knows that, which drove interest rates up. So the 5.9 national average went up to 6.6. Now it's been coming back. It's down around the 6.25, 6.3 right now range, national average. Of course, my rates are lower, as you can see that. That's part of the significance of this whole point that I'm showing you. So anyway, feel free to reach out on questions about this, but interest rates are mostly sideways now because the Strait of Hormuz still being an issue. Ceasefire talks, are they going to go well? Are they going to go badly? What do we don't? Nobody really knows, but now there's enough fear of the inflated gas prices having a demand destruction that now there's concerns about recessions. And so rather than inflation, which would send interest rates up, we've got inflation on one side, but we've got recession on the other, and they're kind of just pulling each other basically into a neutral stance. And interest rates are almost unchanged over the last week. Um, so kind of boring and exciting at the same time because it's a tug of war. And that tug of war, there's a lot of tension on both sides, but that it's not really moving the needle much. So anyway, that's where rates are. Let me know if you have questions on what you see, but I'm going to go ahead and turn that part off and just kind of come back to sharing with you a couple other things. So, um, I like to try to educate people. I love to try to pass on some information from the mortgage industry. And so I'm going to start with appraisals. A lot of times when people are shopping around from lender to lender or even with a broker and we're changing lenders, there's a question that comes up. If I change lenders, do I have to get a new appraisal? And a lot of people are going to tell you yes to that question. A lot of lenders are going to require a new appraisal. Um, yeah, I'm not going to elaborate a whole lot on why, but I just want to point out that if you have an appraisal already done on another property and you want to switch to us, or if we're doing your appraisal and we want to switch lenders with you, in most cases, we don't need to order a new appraisal. And so I'm going to go ahead and elaborate a little bit more on that because the question is simply, if I change lenders, do I need a new appraisal? And the answer is essentially no, you don't. So just to make that simple. Um, but here's a couple of ideas. So if you are getting a USDA loan or you're getting a conventional loan, and you already have an appraisal, you can transfer it if you want to, but you don't have to. So keep that in mind. If it wasn't a very good appraisal, we can potentially get a new one. Another one is if it's FHA. If it is FHA, you have to take it with you, no matter what lender you go to. You cannot order a second appraisal. You have to accept that first one for 6 months. So that's important. If it's a VA loan, it's complicated. It isn't necessarily required to transfer like FHA would require it, but neither does it have no strings attached like conventional. It's kind of attached to the veteran, if you will. So it's a little different. But yeah, so you have some flexibility, I guess, is essentially the point. So short answer is no. If you're changing lenders, you do not need a new appraisal, at least not with us. So there's one thing I wanted to share. Now, I'm going to talk about down payment assistance briefly, and I'm going to talk about Utah housing specifically, and then I'm going to talk about several down payment assistance programs because I feel like one goes to the other. So a lot of people are asking me like, what kind of income do I need if I'm going to go ahead and go, Utah housing or whatever. Now, for those that are not up to speed, Utah Housing is a state agency for the state of Utah that offers down payment assistance. And it's a pretty cool program, used it many, many times. Not always a fan of it. It's not a be all cure all. It is definitely a cool loan, but it has quirks. It has quirks that aren't super cool. So what I thought I would do is go ahead and get you just a quick little, and of course I forgot to grab it before I got in here. But income limits. Utah Housing has got some income limits, and so I'm gonna go ahead and share those up here real quick. And anybody can get this. This is available online. So let me just go ahead and share my screen. You can see, and then I'll kind of walk you through the programs briefly. So if you're a realtor watching this and you want to know, here's the website, utahhousingcorp.org, and then you just going to come over here basically, and you're going to pick, who you are. And so, or excuse me, up here. So you got lenders, you got realtors, right? And we have all these different links. Um, you can't work directly with Utah Housing. You have to work through a lender, and then they kind of talk about which lenders you can work to. Anyway, we do a lot of Utah housing loans, but there are several versions. So the first home is the first time you've ever bought a house, or the first you haven't owned a home in 3 years and you're qualified for their program. If you are a family size of 1 to 2 and you live in Salt Lake County, you can make 122 grand, 123 essentially. If you have a family size of 3 or more, you can make 141 and still qualify. And then they put a price max of 653 on your purchase price. Okay. If you are in, let's pick another one, Utah County, you can see it's a little bit bigger, 142, 166, and 763. So you can check this on any county you want. If you're in St. George, you can make 116,000 and still qualify. And in case you're not quite sure, these are essentially the area median incomes. Not 100% accurate, but those are essentially the area median income for the 100% of it for these counties. And so that's kind of what it tends to follow. That's the first home program. First home, I'm going to go ahead and pull this up so I can show you where. As you guys see, I've got a lot of options here. So let's go over here. I want to see interest rates. Let's do this one because I can show you really quick. Rates, there we go. All right. The rates aren't super awesome, but they're okay. I have to click one more thing, apparently. Current interest rates, there we go. All right, so first home, today's rate, you're gonna get a 6%. And then down here, they've got opportunities to lower that rate down to a 5.5. At 6%, you're paying 1.5% that they're not listing here. So at 5.37 or 7.5, you're going to be paying 3 points to get there. Utah Housing is an expensive loan. Okay, so that's kind of what your example rates would be if you qualify for this program. And if you come here, this is going to be their other programs, right? So FHA, VA mortgage, that's what they pretty much call everything else. All counties, you can make up to 162,000. So pretty high income limit throughout the state of Utah. Loan limits, it's really just going to follow FHA's loan limits in that case, which in Salt Lake County right now is 630,000-ish, and Utah County is 608. And let's see, Davis and Weber counties is 744. Summit County is like 1.1 mil. So, I mean, it just depends on the county. Okay. So let me know if you have any questions on any of that. Feel free to comment down below or message me or whatever. But that's kind of Utah housing. Now, what if you make over this? Is it are you out of luck? If you make too much money, or maybe even make more than this, maybe you're a first-time home buyer. To clarify, if you're a first-time home buyer and you make more than this 122, you can still use their FHA VA mortgage program as long as you're under 162. But if you're over 162, Utah Housing's out. That's what they're telling you. Okay, make sense? Now, what if you do make more than 162 and you still haven't saved up enough for a down payment yet? Then what are you going to do? And so that's what I wanted to address last as I wrap this up today. Um, Before I do that, I want to clarify just a couple more things. So, Utah Housing has the FHA programs that I just talked about. They also have a conventional program. On their FHA program, they can receive up to 6% in seller paid closing costs assistance. That's the seller paying your closing costs for you. 6% is a lot if you don't already know that. 1-2% is pretty common these days. 3% I wouldn't say is super common. Some of the builders are out there advertising pretty big concessions, 6%. And so in a situation like that, we can get you a much better interest rate, even if we still use Utah Housing. Um, and then if you are a realtor watching this and you're looking for some CE, recognize that we do have some continuing education we can offer for Utah Housing specifically, as well as through for appraisals. And so if you'd like that and you haven't had that recently from us, then let me know and we can set something like that up for you. Okay. Okay, let's talk about other down payment options. So if Utah Housing is out because you make too much money, um, then we might have these other programs. And so there's one in particular I want to kind of focus on, but we have what's called the NADA loan. We have Chenoa, we have NHF, we have all of the city grants, down payment assistance. We have some pretty interesting grants like I always forget the name of it. Is it Choice Home? Home Choice? Something Choice. I think it's Home Choice. Anyway, that's for disabled families. If there's a family member a family member who's disabled, you fill out an application with Home Choice, and they're not a grant, they're a loan, but they'll give you if they have money, which last time I checked, they're out. But if they have money, they'll give you up to a $70,000 loan at a 1% interest rate. So the payments are way less. So it'll save you a couple $100 a month, but that gives you some extra buying power because it's going to take and minimize your mortgage, your first mortgage, and the rate that might be 6%. They're going to drop that down a little bit with this second mortgage. So that's a cool program. Um, there's another cool one I'm trying to remember right now. I should have taken notes beforehand, but there's just a lot of different down payment assistance programs. That's kind of one of the main gists that I wanted to get across. And one of those programs in particular, we call it Dynamo. Dynamo, it's a cool name, and I probably should express more emotion than I am because it's a pretty dang cool program, but it's complicated. On the surface, most people look at it and go, "What the crap?" So its closing costs are high. We quoted somebody today on a $450,000 purchase, $16,000 in closing costs. Whew, it's a lot. And their interest rate was a 7.125% interest rate. Whew. So you got a high rate and high closing costs. That's hard. But it's 100% financing. So they're going to give you a mortgage for 96.5%. It's an FHA loan. So they're covering that 3.5% down payment. Well, they're giving you 96.5 for the main loan, and then for the down payment, they're actually granting, the lender is actually granting that 3.5% down payment. But like I said, the closing costs are high, so it still looked like the buyer has to bring 16,000 to closing. May as well just bring your down payment in that case. Nope, because a seller can never pay your down payment for you, but a seller can pay your closing costs for you. So in this case, this particular loan, what we encourage our client to do is potentially inflate the price a little bit, have the seller actually use that inflation to cover your closing costs for you. Now you're coming to closing with zero down, right? 100% covered through the loan. And then when you close, different than a Utah housing loan where you have a first mortgage and a second mortgage, both with big payments, this one, there is no second mortgage. There's no grant, there's no lien on title. You just simply have a first mortgage and that's it because the lender essentially gifted it to you and that's it. And so the day after closing, you look and you have all that home equity. And the reason this matters, because if you remember, I just told you a 7.1 rate and 16,000 closing costs. Why this matters is because you can now refinance with and use that equity. So what we do with our clients, and the lender's fully aware that we do this, they structure it this way, is on month 7, we can actually do a refinance where we pay that first mortgage off, that 7 point whatever percent, and we take you down to whatever today's rates are, which today were, as I showed you earlier, paying points, you're at the 5.7 or 5.3. With no points, you're sitting closer to 6, right? But you're able to get that 7.1 gone all the way down to like a 6. You're going to save several $100 a month doing that. And depending on how we structure it, you might not have to pay anything for that at all, not on the loan or out of pocket. But that's a really cool way to get around needing a down payment, versus Utah Housing, where you're going to have, or programs similar like Genoa and NADA and NHF, and anyway, even the city grants and stuff like that. Most of them, there's still liens on the title to the property. And so if you refinance, they have to subordinate, and some of them just won't do that. Utah Housing's one of them, they won't do that. So now you're able to go ahead and do that refinance, drop that payment to $300 a month, and there is no second mortgage or anything to deal with. And so pretty cool loan. Wanted to kind of express that and show, just because there's a lot of down payment questions that I get all the time. This client that we talked about earlier does have money in a 401k they could use, but they just don't want to. They understand they're getting pretty high rates of return right now, and they don't really want to use that money for the down payment, though it is allowed. So anyway, that's pretty much it in a nutshell. Let me know, like I said, in the comments, or if you have any questions or thoughts that you'd like to discuss in more detail. But other than that, you have a great day. Thanks for tuning in, and we will catch you next time.